Welcome back, friends. No topic dominates the investor concerns and conversations more than that of inflation at present. The entire conversation seems to be rotating around the fact that the markets have gone too far, valuations are very high, and they are prone to correction. So, the moment you hear some rumors about some scam which may unfold, or the fact that maybe one of these reserve banks, the Federal Reserve or the Reserve Bank, Bank of England or Reserve Bank of India, they start talking of some inflation which may, according to them, be sticky in nature and long term, then you feel that the markets are going to react accordingly, feel the jitters, and this is something which is going to rock the markets. But time and again, you have found that most of these central bankers try and belittle to sober it down, say that this inflation is transitory, is not going to last long time, is not permanent in nature, and therefore the market keeps dismissing these inflation concerns. Way back in February, March, you found that a lot of the inflation concerns were shown, and to the extent that the US bond yields went, 10-year bond yields went as high as 1.9% and beyond. They have receded since then. We had a very high consumer price index last week, and the market, however, remained unmoved by such a dramatic number as well. In fact, the Dow rose immediately on receiving this news as if it was good news. So, where do we stand? If you own bonds, then naturally, even a little rise in the bond yields, in the inflation rate, can tend to take the wind out of these bond prices. If you own stocks, but where the growth and the dividend is far overplaying the rise in inflation, then you're fine. So you have to wait and see how much the inflation is and at what level is the growth and dividend yield of the company, and whether it more than compensates for the rise in inflation. Now, time and again, this wage spiral that is taking place has confounded many. Now, don't forget that countries such as the United States have a lot of stimulus checks that have been posted to the people who have been unemployed because of the pandemic. That remains in force even today. Now, however, come September, the story may change. You may find that more people, after the stimulus has come to an end, they have to return back to work. Yet, the way the consumer prices have been rising, this may put a upward pressure on wage inflation, and you need to take that into consideration. There could be some point of time when the bond purchasing program of the central bankers, of the Federal Reserve, may start showing signs of weakening, and Federal Reserve may say, hey, enough is enough, it's time now to come back and start tapering off these bond purchases. Many expect this can happen after some more time, that you find that the inflation is found to have gathered momentum or is holding to be quite steady in nature. So we find metal prices, steel, lumber, copper, aluminium, oil, all rising in reminiscences of the 2008 commodity super cycle. And there has been so limited supply that has come off late that makes it rather difficult to believe that new mines, new copper mines can come up overnight and can disrupt the entire equation, and you'll have supply that will come to match the demand, and therefore the prices can fall. That's also something which is ruled out, because these commodities, steel, aluminium, all these, copper, take time to mine and come back to a level where supply begins to match the demand. So this whole thing which is there is kind of uh, throwing many questions, that what is that striking point? Where exactly will the central bankers, the Federal Reserve, feel that the inflation has stayed its course too long, that it can no longer be called transitory in nature, and this is time to clip its wings? What is that point of time at which you will consider enough is enough and yes, it's time to take action? Do not forget, it's the easy fiscal policy, the monetary policy that has created so much of money and it has got stoshed across the world, and therefore you find various asset classes, risky assets, doing so well. You find internet valuations doing well, companies like Zoom, Amazon having done well. If you look at a country like India, it has so much of its IT companies doing extremely well for such a long period of time, but it has not got many of so-called IT internet companies. Now you're, however, going to see a great amount of new companies, new IPOs, like which are internet based, like Zomato. You will find things like and Devyani International, which are the franchise holders to the Pepsi, the Pizza Hut, the Kentucky Fried Chicken. These types of companies are now going to start coming, and even a very important IPO like Flipkart may begin to. There is talk since quite some time, but these types of new IPOs, which are more internet based, are going to start making their presence in the Indian market shortly. Naturally, they will also be fetching the good valuations that the Western world has given to these and has rewarded these internet valuations. Some of it may turn out to be excessive nature once the dust has settled. Shift of asset preferences to cryptocurrency, to Bitcoin, may be considered good because of the blockchain technology and the ramifications and repercussions this has for further fintech revolution in many parts of the world. At the same time, you will find that much of the moment in the cryptocurrencies could be termed as excessive in nature because of the easy money that has sloshed in various parts of the world. All this again brings back to the question, which is the point of time at which this easy money policy is going to start getting curtailed? Where is the drawing line? Which is the point of time where you can consider that the central banks across the world finally start clipping the wings and saying that now no longer to go ahead? And this will be very important because not you'll find that many of the asset classes which have been going up furiously across the world, not only in the United States but elsewhere as well, are close on the heels of this easy money policy. Now, this is the multi-million dollar or multi-billion dollar question on the basis of which asset allocation takes place across the world, and that's why it is so very important to understand where is inflation headed from here. How much of it is sticky in nature? How much of it is going to be due to supply chain shortages like the semiconductors, the chips that you have? How much of it is pertaining to that, and how much of it is purely based on the fact that because of the pandemic, there were not many workers to mine so much copper, aluminum, oil, and this is why these prices are going up. And once these vaccinations are done across the world, then by and large you'll find that much of the mining can resume, much of the oil drilling will return back to its old days. All this brings us back to the fact that there is also in the background a lurking chance that we may see a third wave of the coronavirus begin to appear, and whether the vaccines which are available in many parts of the world are sufficient to tackle them. So there are many things. Most of it deserve a quick and an urgent resolution, and need to be done. Need to be done quickly. Need to be thought quickly, because this is on the backdrop. It's in the backdrop of this inflation argument that the entire story of the world is of various asset classes and how they are going to move. I personally believe that this is something which is so critical and so endemic in the financial system that if you were to look at it carefully, I think the problem itself shows the solution. If you look at why these asset classes have been going up and which is the point that has triggered such a huge rise, This itself carries with it the answer as to what point of time the Fed will begin to taper off its bond purchases, which is the point of time at which the interest rates will start rising. The problem itself carries the solution. If you're still not convinced, stay tuned. If you're not yet part of my YouTube channel, please do join and look forward. We will be coming back with more. What is that point of time? We will definitely give you all the answers and very soon. Happy investing. Take care. Bye bye.